Welcome back to the Rate of Change with York Wealth Management. As advisors to some of the wealthiest families in the country, the Rate of Change is a podcast designed to help you in the pursuit of building long-term wealth through the insights of some of the brightest minds in asset management. I'm your host, Murdoch Gatti, and in today's podcast, I'm very happy to welcome back Jason Coggins. Many are familiar with Jason Coggins. He's brilliant, great at macroeconomics, strategy, asset allocation. But for those who aren't familiar with Jason, do you want to jump in and do what you always do and give a bit of a data dump of who you are, what you've done, and who you're working for currently?
Of course, Murdoch, thanks for having me on. I always enjoy this discussion. So, look, I spent most of my career in private wealth, looking after research teams, finding investments, constructing portfolios for a range of clients, high net worth individuals, endowments, and family offices. So about 4 years ago, I decided to exit that world on a full-time basis. And I decided to go in the world of consulting. So I now consult to a number of fund managers, primarily two, one being Aura Group, based in Singapore, and another being Ellison Capital, based in Sydney. I also sit on a number of investment committees. So while I've exited, a full-time permanent role in wealth, I sit on a number of investment committees in private wealth. And I also sit on a number of charities with Chris Guff, so Australian Philanthropic Services and Third Link. So it's a bit of a variety. I think having, and I guess Aura and Ellison take up most of my time, but the investment committees gives me exposure to, still how people are investing, where they're investing. And so the synergies across all of those groups is extraordinarily strong.
What are the groups mainly talking about now? Like I suppose think about it now, probably the best question is when you sit down with these people, what's the main thing on their minds?
Yeah, so look, I think for Aura, it's a stage of significant growth for the business. Having raised capital for the headco level, will embark on quite a large growth strategy over the next 12 to 24 months. It's a private markets manager, both in Singapore and Australia, with, a wealth business in Singapore and an accounting business in Australia, and a number of associated investments such as BetterX, which is a digital platform. For Elliston, it's being able to take opportunity when there's dislocation. We've just done a few deals there in private markets in Australia. So Elliston is a bit mysterious. A lot of people don't know exactly what's under the hood, but the business has been around for 2 odd decades. Previously part of the Kerry Packer family office, Consolidated Press. Later coming out of that, and really today, the way I look at Elliston is really the life cycle of a small to medium-sized company, both on the private and the public side. So in Australia, there's two private market platforms in that business. One is the very successful Jade series, which is later stage technology, education, health type businesses. And the second is the industrial growth, which I like to explain it as widgets, buying, high quality companies, call it a construction engineering business or a power distribution business. These are typically privately owned by family members who founded these businesses. Ellison will come in and really institutionalize those businesses. So I think, markets have been very, there's also a big listed business in the Ellison business as well. Look, I think if we were talking about a month and a half ago, obviously the start of the Iranian conflict was on everybody's mind, but there appears to be nothing, that's stopping these markets. So I think we are, all enjoying what has been a very strong period over the last 2 years. And I think some of the things that, the threats and the opportunities, we'll talk about this later, but the adoption of AI and integrating that into businesses and really leveraging productivity improvements, I see that every day. And that's both in those asset managers and then also in the wealth groups that I work with. AI is going to change the way we do business processes and the types of skills that are required in these businesses. And it's really a race to improve productivity in these businesses. And, I still see businesses out there that I talk to that really have their head in the sand and are not looking at the amazing opportunity that AI can bring to businesses. And I think you'll start to see, just like you will with employees in these businesses, you'll be able to differentiate productivity. I don't think we've seen the mass layoffs yet, but if you have an employee who is using AI, their productivity will be markedly higher than the employee who's not. So I think the pace of change in businesses, I think the pace of change in asset management, I think the potential pace of change in wealth, given some of the government policies that may come out at the budget next week, there's a lot going on.
Yeah, there's a lot going on. I reckon, I don't know about yourself, but I feel like, anyone in my industry or your industry or all our mates that are running their own businesses, it kind of feels like that everyone, somehow they managed to get pretty much like $1 million, worth of salary out of these AI for what is it like? What's grok? $500 a year?
Mm-hmm. Mm-hmm.
It's crazy to think. You can essentially replace entire skill sets. But most importantly is, can you ask it the right questions? And do you have the comprehension and the level of understanding to identify whether or not the information is actually accurate in order to help? It's quite a skill set to have.
It is. I'm quite pessimistic long term on the impact that AI will have on the employment market, particularly white collar labor. However, right now, I look at simple things like, getting enterprise version of Claude and really integrating that and being able just to ask simple questions like, where is such and such? Where is this financial statement? Where is the latest IM? And you can go in there and it'll tell you where it is, right? So it's the incremental productivity improvements are now. I don't think you've seen mass layoffs yet. I think in the US where technology has actually seen mass layoffs, I don't think that's AI, and I think businesses are using that as an excuse. I think that was really the overhiring over the last 5 years. But within 5 to 10 years, I don't know about you, but I can do a lot of my accounting work now. I can create a basic template for a legal or an employment contract. There's a lot of things I can do. I can connect it to my accounting software, and it can go through my emails and PDF and attach those to transactions in MyOp and submit those expenses through agents. Like it's incredible.
One thing I need to fix is I need to figure out a connection for WhatsApp for essentially, that's been a big change. Like these days, all communications, say with clients and everything, used to be email orientated, but these days everyone communicates essentially through apps like WhatsApp. So if anyone knows how to integrate WhatsApp via these AIs for essentially, CRS, that'll be invaluable.
Yeah.
But it's all essentially encrypted for a reason.
Exactly.
Look, God, we can go down this rabbit hole, but why don't we, it's been a number of months, probably about 6 odd months since we spoke. It has been one hell of a game for the first half of the year. Do you want to do just a bit of a recap on the highlights, the main themes that have essentially been driving these markets that you've been watching?
So I think first and foremost is the Iranian war, number one. Number two, I think that war has exposed some fragilities in emerging markets. Emerging markets has never been one market, but the differences between if you have oil or if you don't, but then also the rapid outperformance of North Asia in emerging markets, so South Korea and Taiwan on semiconductors. I think the productivity challenges in Australia and the inflation story in Australia is nothing short of diabolical. The spending and the lack of fiscal constraint is really crowding out the private sector here. To think this time 6 months ago, we were forecasting potentially having rate cuts to now potentially rates going up to 5%. And there being no sense of urgency from our political leaders is something that I would be quite fearful and would be watching. And so I think, look, the war in Iran and all of these things are actually linked, right? All of these things are linked and really highlight how we are still very reliant on global supply chains and the global economy. And unfortunately, there doesn't appear to be a quick off-ramp. Some of the interesting things is just Middle East geopolitics, how the UAE, how Saudi Arabia responds. They've effectively banked their prosperity to stability. And so having a fragile truce is simply not an option. And so, look, I think the next 6 months to the next 12 months, and of course AI, the last thing, the next 6 to 12 months will be very similar. the market is still very well bid for. Every correction, I mean, this was the shallowest correction, if it was 10% ever. Uh, there was a great chart in one of the rags that just showed how long it took to get back before a crisis. This was the shortest ever. So look, I think the market is, factoring in a quick resolution and a temporary spike in inflation. But every day the uncertainty persists, the more difficult it is to be constructive on a short-term basis for risk assets.
They always say in life, if you truly want to understand how to see the future, you must understand the history of the past and how wars are being fought. And what's weird about us now is, when was the last time a real war was fought, like openly? People say it's World War II, but there's wars kind of happening all the time. It's just a different kind of war. But if you think about, before cannons, and you had sieges, right? And you had two countries going up against each other. And where I'm going with this is, you have, I'd argue that we've essentially been in an intellectual and economic war for a long period of time, right? Essentially the West, versus the East. Mm-hmm. And for 30 odd years, they had a plan to essentially sunset the West, make it go bankrupt, and then essentially run their own entire program, which was working. And that's essentially how, and Doge has found all that corruptness. They found essentially all those, the NGOs, the 14 computers just printing money. Like there's a whole bunch of fraud and corruption going on left, right, center. But then you have someone come through and then just make a game which everyone understands how to play it for 30 years, which is to a point stable on one side, but then not stable and not beneficial to one group of people, and then flip the board and go, actually, hold on a second, we're going to do a number of things. Like what Trump's done, I believe, is he's essentially, like from a siege perspective, where I was going with is, he's gone, right, we're at war. What do we need to do first? We need to make sure the castle is safe. Okay, check, castle's safe. Mm-hmm. Next, we need to make sure the middle class and our workers are safe. So let's bring the jobs back, and kind of deal with NVIDIA. Cash comes back in. And then thirdly, okay, we need to go after our competitors' resources. So, China controls 90% of the world's rare resources. Mm-hmm. And then what did he do? The next step was, Russia, Ukraine, Venezuela, and now Iran. So why I'm bringing this up is, what's your opinion? Because it's like a medical thing, people often try to treat the symptom, or sometimes you look at the cause. And if you understand the cause of, why this is happening, then potentially be able to see how the game's going to play out, and then you can essentially adjust. So a bit there to unpack, but I don't know what to tie this heading underneath. It's essentially like, what's happening with the world geopolitics, because there is definitely a war on resources going on.
I would have said before Iran, it was really clear, right? So Trump was focusing on his own hemisphere, and that's all he really cared about. He wanted Europe to fight its own wars, and, looking at Venezuela, that highlighted that, right? That's his hemisphere. The Iranian war kind of threw that out, and I'm not sure that he really wanted to get into this conflict, and I'm not sure he really wants to be there now. I think, the Iranian war, if he got caught into it, the problem is that this is a country of 90 million people. There is no opposition party. If you want to attempt regime change, you probably should identify who is going to take over. And it's a very, disparate kind of region with, allies and sects, right? So, look, I think the Iranian war it's strange given what Trump has done in his first term and what he attempted to do in the first part of his second term. But the bigger picture is, I think when he came into power, and we might have spoken about this last time, there's no beating China, right? There's going to be two ways this world operates, right? And that's going to filter through to AI and then also regional kind of who looks after what. I think when Trump came in the second term, they realized they were very far behind in the AI war. And I think the US genuinely believes that it's a winner-takes-all market in AI. China had, behind the scenes, been investing significant amounts of investment into low energy sources. Call it nuclear, call it solar, call it wind, but also reamping their coal. And what feeds AI is power and obviously resources. So I think to give Trump credit, when he had that kind of Oval Office meeting with the tech bros who came in and told him that they were behind and they needed to do everything possible to get at least level. Now, I don't think it is a winner takes all market in AI, but don't underestimate China. China has as good, if not better, scientists, and they have that kind of collective organizational capability to harness these types of things. The biggest threat for the US is a capitalist society, right? So they will let capitalism run AI and its rollout over the next decade. And that is pretty horrendous for low skilled or repetitive tasks that automation can replace. Conversely, China has a very, very strong social safety network where they look after people. And, it's a communist state. And so in my head, I think if you're not part of the economic story in the US, the poor will get poorer, and the rich will get richer, and there'll be an even greater concentration of wealth in the US. That's capitalism. I think China can do that a lot better. So we've kind of got two systems running in opposite direction, but trying to achieve the same thing. And who knows who's, I can see the problems that the US will find itself, that it will get itself into. But yeah, I wouldn't discount China.
No, it's not a discount. I just kind of feel, and a lot of my clients and family I chat to, it kind of feels like Australia is the meat stuck in the sandwich. Or
100%.
essentially, a video popped up the other day of a mosquito, and someone's put something in front. I'm like, is that a magnet? And then all of a sudden, on the other side, he dropped another magnet, and sure enough, that mosquito got squashed.
Yeah, Australia is in a difficult situation. Allies are no longer reliable allies. And if the US is taking a more insular approach, that's a pretty difficult situation for Australia, who ties its economic prosperity in this region and our defense stability very far away. So it's a difficult situation to be in. Other countries do it pretty well. Singapore, for example, but Singapore is tiny, right? Australia has a massive landmass that it needs to protect, and at this point is probably unable to protect.
I heard, it's an unfortunate comment, but I heard a comment, they said nobody cares about Africa. They go and they take the resource and off you go for hundreds of years.
Yep.
But someone said it the other day. It's as I said, Australia is starting to appear to be a little bit like Africa in the essence, where you have, to your point, right? We're heavily reliant on essentially the funds coming in from China. They're the main purchasers of a lot of our resources, right? And the cash comes in. We've had a lot of great families land, they buy property and everything. So there's that one thematic. Then you have the Western side on the other side, but then you have a lot of corporations coming in. And look, we're invested in all of them and essentially, getting the most out of the land. But then you have a number of, political parties that have made it very, very difficult, like say for the gas component to essentially, operate. They shut down coal. I think we had, 12 refineries 20 years ago or something? And I think after World War II, they said we will never have a situation where we'll never have refineries again because we're going to get caught. We have two. And when there's a fuel crisis, somehow the one in Melbourne, which operates 50% of the gas supply, the oil refinery for Melbourne and 10% of Australia, blows up. Like, we're now down to one. So I don't know. It just kind of feels as if there are politicians in Australia. I don't know if where their loyalties lie or whatever's happening. But it kind of feels as if we're stuck between two major parties, and it doesn't feel like a lot of the policies are actually in Australians' kind of best interest. I don't know what you think about that, but the biggest one that's really doing the rounds and capturing essentially everyone's attention on social media. Come on, if you listen to this podcast, you must have seen Pocock, or you know who he is. He's played for the Wallabies, but he's up there right now with the single, best meme of all time. Australians are paying more tax on beer than essentially, receiving from the gas industry. So I don't know. like what's actually happening with this entire space with Australian politics? We kind of feel like we're just been hung out to dry.
It's frightening and absurd, to be honest. Like, you look back in 2005 when we were investing massive amounts on, offshore and onshore gas, right? And at one point, we were the largest exporter of gas in the world. And then we just simply made it harder and harder to do business. And, out of nowhere, Qatar came up, and now the US has come up. So we definitely don't make life easy for capital or for business to set up here. We set more and more restrictions. It's becoming more and more difficult to do business here. The proposal to put a 25% tax on revenue on gas.
Is it revenue or profit?
I think it's revenue.
Revenue makes no sense. It will kill the industry. Profit.
It will kill the industry, and I think it already has killed the industry. I mean, we haven't seen a large-scale gas plant turn on for a while, right? I think IPEX's facility up in facility up in Darwin was probably the last one. We have extraordinary resources in this country that we should be harnessing as a competitive advantage. And I think a big part of the problem is that we have career politicians who've never worked in industry or never actually managed a business or managed a budget. And the short-sightedness of electoral terms is really damaging.
3 years makes no sense.
I don't want them longer, but I think
how do you get anything done? The first year you try to get something done. The second year you're fighting for your life, and then you have to re-elect again. You're getting nothing done. And then if you go, well, okay, what's your thoughts on? We saw it happen with Trump, but Trump essentially joined a particular side. RFK did the same thing, ran independent. What do you think about all the noise around, the One Nation with what's happening and throwing a spanner in the works? Is that a necessary scenario? Is it good? Is it bad? Or I don't know. To your point, we're in a high inflation environment. It feels like a lot of our greatest resources aren't being utilized. China is stockpiling mountains of our coal, and everyone's like, it's bad to have coal. It just kind of feels like we're getting squeezed.
Yeah.
And Australians' cost of living is just insane.
I think the politics can change really quickly, right? So while it doesn't look like we have a functioning opposition party, things can change very quickly. And I'll give two kind of examples of why that's kind of shaped my thinking. So one, if you think back when Campbell Newman won his term in Queensland, and the Labor Party failed to win more than 5 seats. They didn't even qualify for party status. They had to have an agreement with the Liberal National, which they call the Coalition. It's actually a single party up in Queensland. They don't split, to actually allow them to be an opposition party, the Labor Party. Now, there was a belief that Campbell Newman had 3 terms easily because it would take so long for the Labor Party to come back. Well, evidently, Campbell Newman went a little bit too hard on cutting the public sector, and he lost the election the next term to Anastasia Palaszczuk, who ended up being a 4-term premier, right? I've also had a real fortunate opportunity to spend some time with a former Prime Minister in Australia. And, he was, I won't say what side of the politics he's from because that will give it away probably, but he said politics changes. Like when the wind changes, it can happen pretty fast. And when I look at the One Nation vote, it looks like it's a breakaway from the Liberal National Party. That can always come back pretty quickly. So I would be very cautious in looking at what politics looks like today and extrapolating that to the next election. I would say, though, that at a 20% primary vote to 24% primary vote for One Nation, that puts them in the box seat for the Senate to have really a blocking group in the Senate. So I think their rise has really been disillusionment with the major parties, both Labor and Liberals, but it's really come from the Liberal vote. I'd also say it's a very shallow majority. The last election was won on a very small primary vote, and the Prime Minister gets that. I think it's 94 seats, which is a huge number in seats. but it was won on a low 30% primary. So that can change very quickly. Now, when people vote next year, I think it is, cost of living, like you said, will be a major issue. We've gone backwards for 3 years in GDP per capita income, right? And you can argue that, it was distorted by a big, increase in wealth during COVID, post-COVID. But we've gone backwards. We know the productivity challenges of the economy. We know the economy can hardly grow above 2% before inflation becomes a problem. It is not normal that we've already seen 3 rate increases before any other country, bar maybe Japan, which is, orchestrating inflation deliberately. The forward curve in Australia has another 2 rate increases. Like, that's diabolical. Yes, we started the 2026 period with better than expected growth, and the RBA was caught on the back foot. But a big part of that was, private demand was good, but the government spending side is reckless. And so we have a spending problem, we have an inflation problem, we have a productivity problem, we have a policy drought in terms of getting the economy back on track. And unfortunately, there's nothing from either side of politics which suggests they're taking this seriously. And that will impact everybody's well-being, quality of life, wealth, employment prospects. So it's quite damaging. Now, I don't want to be too negative because Australia still has some very good attributes. It's a great place to live. A lot of people want to move here. It is a very wealthy society, thanks to superannuation. And despite being quite negative on reform, it's still not the worst managed economy in the world.
What do you reckon is going to happen? Like with Labor when they got into power, right? It wasn't the Greenies and the guns that banded together to get the votes. So to your point, like a blocking vote, right? In order to get them over the line, and they gave them the control.
Yep.
Is there? What I'm mainly wondering is, okay, fine. Let's have a think for a second. Why is One Nation up and going? Why are people jumping on that bandwagon? I would argue, to your point, with AI, you have mainstream media not really doing its thing anymore. You have podcasts like this. Yep. It's easy to get access to information. You're seeing changes in scenarios like what's happening over in the States that people thought would never be possible to change. You're seeing changes to vaccines. I think I saw about 3 weeks ago, RFK pulled the Hep V from the kids one, which is fantastic. Like, there are huge changes coming through. Like, glyphosate is pure poison, but if they can't pull it, otherwise no one will eat, because 98% of corn is Roundup Ready corn. Like, there are all these particular changes kind of happening. And then I suppose Australians are looking at it and going, well, we need essentially a vote. Like, we know we've got coal, we know we've got resources, we know that we're in a great position, but it kind of feels like the hand that we have to play isn't being played the way that they want to be played. But then the question becomes, with that power, is that power best to essentially be in the party that the people are backing, because it's essentially the only choice that they have, because they feel essentially the party they back for years isn't listening to them. So to your point, they're jumping a ship. Mm-hmm. Or will most likely One Nation end up banding with, say, the Liberals, and then essentially with the Liberals, operate it from a business standpoint? Like, I don't know. I'm just wondering, how do you reckon this will go down?
Look, I think there was a by-election in Victoria last week, Nepean, and I think that was the first, and that was a regional seat, right? Semi-regional. I think it was Nepean. Yeah, it was. And you saw the One Nation vote, in the 20s, I believe. I mean, the Liberals won that still, so the preferences still flow a particular way. But it is making it more difficult to predict which way seats will go. I think the bigger issue that we have is that the economy is still doing pretty well, right? When the economy takes a turn, we have no sense of urgency to fix problems, which are easier to fix now when the economy is doing well than what it will be to fix when the economy is not doing well. And unfortunately, it's becoming theatrics, right? And it's becoming very stubborn. Like you look at the capital gains proposal to change. On a high level, it might, people may see it as a vote winner. But when you just have this blinkered eye approach, it's going to destroy parts of our startup sector. It's probably going to make no difference to housing supply. And so why are we focusing on this? The real issue at heart with Australian politics is the spending problem and a waste problem. We've seen the corruption in Victoria. We've seen the corruption which is endemic in the NDIS. Like, this is a spending problem. Like, I don't want governments to, find ways to increase taxes to simply spend more. Back in my, studying economics, the crowding out of the private sector happens, right? You spend more money and the government becomes a bigger part of the economy that's naturally inefficient. You crowd out the private sector, and you're starting to see that. If you offer someone who's reasonably productive $80,000 to go work in the private sector, or they can get $140,000 in the NDIS and not do much. And I'm not saying that NDIS is great, but the amount of money that's being spent on it and how the money is actually getting to people who need it is not efficient. And so if you look at jobs growth, over the last 2 years, a large chunk has been the NDIS. Part of that's right, part of that's not right. And so we have a fundamental issue in this country that there is a significant amount of waste that's not feeding through to the economy on a productive basis. We saw that with the big build in Victoria. It's been outright corruption. I mean, these things should keep people up at night. This stuff should make us angry because, the Treasurer will come up in Parliament and talk about the need to be prudent and be diligent, and hence the changes. But maybe they should look at spending first, because that's the easiest thing to address.
Well, the thing that I just find fascinating, and you're right, the widespread corruption, the Doge team found it as well. So, where there's bureaucracy in the government, there's probably, someone that can figure out an angle. But the one that just keeps me up at night is you have the two biggest players on the market, even the third, with Russia.
Mm-hmm.
You have them essentially in an energy war and an AI war and a tech war on like semiconductors and parts and ramping up. And that's essentially the game. Meanwhile, we're in the middle with the ability to literally have all the resources and produce all of it, like all of it, every single thing that one of these people need. We have all of it in one place, right? But our policies are restrictive. We're not allowed to use, like for all the uranium lovers out there, right? Paladin, you name it, right? We love uranium. We're not allowed to use some of the technology on some of these nuclear reactors are like half the size of a football field. They're fantastic. You just put them on. Some of the tech is insane. Like, what was it? Amazon bought essentially a factory right next to a nuclear power station because, to your point, Tech Bro said we need energy in order to power these grids. We're going to have brownouts. It's not going to work. Like, we have all the energy and all the resources in an energy and resource war, but essentially the politics of our nation are essentially blocking us from being, getting a big seat at the table. It doesn't make any sense. Does it make sense to you?
No. So I think the Prime Minister has been very hesitant, right? He's very focused on his legacy and potentially having a third term, right? That's what I think drives, his day-to-day, approach to policy. I think the Treasurer wants to be a reformist, and there looked like there was a bit of frustration between, the Prime Minister and the Treasurer. But I'd question the quality of the proposed reform, right? It's not making me excited. It's not addressing the fundamental issues of this country, which is productivity. The RBA has been at pains to stress this, that the non-inflation adjusted rate of growth is no longer 4 or 5%. It's like 1 or 2%, right? Our economy can't grow fast without stoking inflation, right? We are not a European economy that should be growing at 0 to 1%. We're a reasonably young population. We, tend to have, by and large, very high quality immigration, very well educated individuals who contribute to society. So we should not be in this low growth route. Like, it just makes no sense. And I would challenge everybody when they listen to the budget, spot the actual piece of reform. We're not talking about tax increases. Spot the actual piece of reform.
So, from your opinion, as an economist, looking forward based on what currently exists, and the other thing why this is very important to think this way is we're not discussing the parties. Leave alone the parties for
Yep.
a second, because people can get hot and bothered, but left,
Yep.
right, down the middle. It doesn't matter at the end of the day. I always say to
I'm a
people
libertarian. I'm a libertarian.
I just said at the end of the day, what's the policies and how is it going to help you and your family and your business succeed, right? So and your country. So what are the main reforms do you think are required for Australia to essentially put us on level footing? To your point, like China and Russia and the States, it's not a winner takes all; it's a level footing. What do you reckon will put us in a position, considering we've got all the resources and we've got the brains and we've got the people that essentially could make us something for the future?
Yeah, so I think it's back to basics. So I think we need to address energy costs, right? Now, a lot of people will look at me and go, oh, but my power bill's fine. I get a $100 rebate here and there. The real issue is what a wholesale rate is, right? So if you're a widget manufacturer, you can't have the energy price spiking like that. It destroys your business, right? So if energy, can go negative when the wind is blowing and the sun is shining, and it can go really, really high when a coal plant is out of action, right? We can't have those swings because that just kills the manufacturing sector. So we need to address energy for good. If I don't think, either side of politics has had an honest discussion around if we go down the renewable path, how much this will cost. Because, we have been spending $1 trillion cumulatively on renewables, and it does not address the issue that wholesale users of power, i.e. the manufacturing plant, the business, the smelter, can't run their business with where energy prices are now, is number one. Number two, we need to reward success. Now, this might be a little bit of a controversial statement, but if you're working your ass off and you're on the top marginal tax rate, it's not 47% tax that you're paying. You're paying 47%, plus you're paying 11% of super, which you won't be able to touch until you're 60, plus you're paying 10% GST on everything that you buy post-tax. You're looking at like a 67% tax rate, right? Whether or not we like it or not, that's what it is. So yes, this country is a great place to live. It's safe, it's clean, it's got good healthcare, it's got good education. But to tell me that people who want to work hard and contribute and be successful should pay higher taxes does not make sense to me. So we're going to get the supply side right of the economy. The economy needs to be able to produce. It needs to be able to do so without stoking inflation. And we need to get the incentives right. Two simple things.
I just find it funny. I was just thinking that you work for Elliston, which is essentially the legacy of Packer. God, I love Packer when he stood up in front of the courts and said, look, I'm happy to pay my tax, but I'm not going to give you an extra dollar that you don't need, because quite honestly, I don't like the way how you're spending it.
Yeah.
And in all honesty, you have all these regulations coming in. I've got an idea. How about you pull two before you add one and actually think about it?
Yeah.
Immortal words by a great man.
Back in economic school, we were taught, right, the budget is like an automatic stabilizer. When the unemployment rate is like 3.5% to 4%, and the economy is doing okay, the budget deficit should not be where it is. It should be kind of managing the ebbs and troughs of the economy. But at the moment, it's being used to drive growth and drive a policy agenda, which, again, I go back to that point. It's easy to fix now when the economy is in a good spot. It becomes really difficult when you're forced to have to make changes. And a completely different economic structure, given we control our own interest rates in our currency, But let's look at Greece, right? When Greece was forced, and Greece is actually in a really good position, the economy is booming, but the medicine that they had to take over that decade was extreme. So I think prevention is better than having to solve the problem when you're on your knees. And again, I'm not saying Australia's in that position because we're not. Like we actually,
We're not on our knees, but like as an example, my folks bought in Roseville
Mhm.
at my wife's folks bought in Cherrybrook at a 3-to-1 salary, say 40 years ago.
Yeah.
My parents bought 30 years ago in Roseville at say 6-to-1, 5 to 6 to 1, something like that. Right now, it's either 11 or 12 times 2-1 in a 2-income household for
Yep.
essentially anyone to pick up a property. And I don't think that numbers were probably pre-COVID as well. So it's probably gone up further. And then right now, New South Wales market and property's kind of stabilized a bit, but Queensland's now booming. Everyone's just kind of rotated north.
Yep.
So what do you reckon is going to happen with, because a lot of people listening to this as well have just had the interest rate happen. They've seen their mortgage have to go up.
Yep.
The borrowing rates are higher, right? You might have been on 100 grand and your mortgage is only 200 grand. You probably owed like 300 grand or 400 grand now, but you just borrowed $3 or $4 million. So, what does that mean to a normal family paying off a mortgage and all investment properties?
It's pretty horrendous. So it's pretty horrendous, but maybe being a little bit more optimistic, because I've probably been a little bit more pessimistic as the economist as the budget comes up. But look, I think there's still some positive aspects. I'll take you through a positive macro, and then I'll take you through a positive why you still want to invest in Australia. So first of all, I think the market, equity markets are at record highs, near record highs, right? Today was a little bit weak, but we're near record highs. The market is factoring in a quick resolution to the Iranian war and the blockade, and that oil supply and energy supply will get back to normal pretty quickly, right? And what that means is that the market is effectively factoring in that the inflation spike that we've seen will be temporary, right? So it's a positive. So it's hard to bet against the market, but to be cognizant of the other risk is that it's not temporary, and every day this goes on entrenches in inflation and prices, right? So I think the market is definitely factoring in that this is not an end of the world scenario, and inflation will be contained. The issue is once inflation seeps through, people don't cut prices, right? They don't cut prices. So, you want to nip this in the butt pretty quickly. The RBA, and I spoke about this before, but the RBA is in a unique situation that the first quarter really started much stronger than they anticipated. So they were always going to raise rates, and what's happened in Iran has just kind of allowed them to do that more easily. So, the ideal scenario is we get in the second half of the year and this is resolved and inflation is settled, right? That's a positive. On the market side, and maybe changing topics a little bit, while the Australian economy definitely has productivity challenges and policy challenges and growth challenges, the kind of that manifests itself really in the largest companies, right? You look at the earnings growth of the ASX 20 over the last decade, it's almost non-existent, right? Now, that doesn't mean the stocks haven't gone up, because they have. It's just like multiples going up and up and up. And a big part of that is just the flow of superannuation every month coming into the Australian market and having to buy large companies. I've spoken about this many times, and I'm very passionate about this, but I think the small company sector in Australia is very resilient and continues to kind of grow somewhat independently of the economic cycle. The kids coming out of university in Australia, they're fantastic. They create great companies. And what you see is it's a real great launching pad to develop a company here, kind of optimize it, and then get a US partner to come over and grow it in a real market, a real large market. So I think, our education system, the quality of our students, the quality of our institutions, the quality of our scientific institutions is still extremely strong, that those institutions do create a lot of opportunity. But we should be protecting that at all costs. And policy should be protecting that at all costs.
How does currency, how will the currency essentially impact this? And look, I'll state where I got this information from. So I used to be at HiFX, which is now owned by Ozforex. Good old BDM. I think my biggest clients back in the day were United Petroleum Petrol Stations, Feared and Fuels, Guest Watches. It was good fun. But I worked with a couple of guys there that I saw essentially the only reason why ASX listed businesses, which their clients did a profit for the year, was essentially they're managing their currency book. And I'll give them credit. Look, Thomas Averill, Rochford Capital, I think they're running the currency for one of Shore Partners' portfolios. I went to one of their lunches and he was discussing the currency and the impacts. He pretty much covered everything you're covering.
Mhm.
And that when then someone asked him, what's your view on currency? And he said it is a high probability with a whole bunch of volatility. The Aussie US may get to 80 cents by the end of the year. And then over the next 8 years, it potentially may get back to parity, right? Now, why I'm bringing this up, why I find interesting, is I remember something Trump said. Trump pointed out the reason why China boomed so greatly was they pegged the currency, so it was cheap currency. So it was very cheap to essentially toss all the money into that country, build it all up. Then when it got to a particular point, they went out. So it's been great that we've had the cheap currency money coming in, but how will the rising strength of the Aussie dollar and what would be the impact of that for potentially international money coming here or essentially, Australian assets?
So I'm definitely bullish the Australian dollar, despite my policy fears and being very passionate about policy and good policy. If you're a reserve manager, i.e. a central bank or a sovereign wealth fund, and you got to allocate money, right? Lots of money. There's no other country that has the liquidity of the Australian dollar, that has a AAA credit rating, and that has the highest yields, right? So interest rates, are 4 and a bit. We have a AAA credit rating, and we're a liquid currency that is used by a lot of hedge funds and a lot of investors as a proxy for global growth and a proxy for China. So those interest rate differentials will drive the currency. And most importantly, currencies tend to overshoot on the upside and the downside. So there's definitely momentum behind the Australian dollar. I would agree, it's probably going to get to 80 cents. I'm not sure that's in fair value territory, but just the tendency to overshoot, I would see it at 80 cents. I mean, if you're a reserve manager, and also taking geopolitical risks, right? So the UK is even more of a basket case at the moment. You can take a view right or wrong whether or not you want even more US exposure. Australia and Canada look pretty good. Interesting, the New Zealand dollar, I didn't realize this, but the Australian dollar is up like 20% against the NZD. To me, that looks like the current government is taking its medicine and enacting some pretty tough policies that are seeing growth come down. But in these kind of smaller countries with still good credit ratings and still manageable debt, we don't have definitely seen a massive increase in debt, but we're nowhere near as indebted compared to, say, the US or Japan or Europe. So I'm positive on the AUD based on relativities and based on where you get the best interest rate differentials. And look, I don't see the Fed raising rates. I definitely think they're on hold. It's kind of like a hawkish hold. But in Australia, I don't think the RBA has any other choice but to raise rates at least once more.
So what does that do with Australian assets and potentially money coming in? Like basically economics, right? Low currency, if you got a week over there, the US dollar is going to weaken. Well, you whack a whole bunch of money to the Australian, invest here, it goes back up, and you shift it back out again the other side, right? But have you seen essentially an increase in, foreign investment coming through, or has it all pretty much landed already? And I suppose where I'm going with that is, how you love the private companies, the companies starting up and off they're going. Have you seen a lot of that money coming in? And with the current rip from 60 cents into nearly 72 now, are people going, it might just keep going, we need to kind of get our cash into Australia first to boost it up? Is the growth here, or is it just, as to your point, just self-managed super funds just pushing everything along?
I I like private and public, small to medium-sized companies because I think they're more agile. They can do things with more. They don't need as many people. They don't have the bureaucratic systems. They're, I know we're going around in circle, but AI is never going to be integrated into CBA or Qantas or because there'll be the bureaucracy, right? We can't do this. We'll do it really slow. Go to a small company, they're like embracing it massively, right? They're like embracing it. So that's why the aspects that I like about small companies. Look, in M&A, you actually haven't seen a huge uptick in M&A. There's some regulatory changes around the requirements for M&A that made it a lot harder to do. You definitely saw a bunch of opportunistic takeovers when the currency was like 65. A lot of them didn't go through, but you did see some opportunistic takeovers, mainly from US groups. But I think where that money flows through, it's as simple as if you're a bond manager, you can earn 4.5% on Australian government bonds. Like, that's pretty attractive, and it's AAA rated. So that's where you've seen the flows. But also another thing, this is probably, there's no evidence of this. There's indirect evidence, and we're going to change topics again, but
it's half the fun of this conversation, mate.
Like superannuation, the big industry super funds, the ones that were taking a lot of the money, but ultimately became a little bit, lazy, and we're not offering a solution for clients who wanted to be more engaged with their super. So obviously, super's still growing in totality. The big guys are still growing. Last year was the first year that more clients left industry super than new clients joined. You're seeing this massive rotation, and still everybody's growing. So, Australian super is still going up in terms of its FUM that it manages, but the number of clients it's losing is greater than the number of clients it's winning. And all this money is coming into SMSFs and the platform-oriented companies, so the hubs and the net wealths and the financial advice firms. When people get to 50 and they've got a mil or two in super, something switches or something must switch in their brain and they want to take more control. Now, what you're going to see is the super funds, the industry funds, had become so big that they were naturally investing offshore. So there's huge drag on the capital account, which is like, the amount of money we invest overseas versus the amount of money others invest in our country. Super was really driving that. So for every dollar that was going into industry super funds, a lot of it was making its way to the US. As people want more control and bring super back to their kind of control orbit, you're going to see some of that money come back.
And invest in Australian equities, is what you're saying, or Australian private businesses, or just
Property,
private credit, property, essentially, landing back here. So, okay, so I was chatting to someone else the other day that said, if you look at the NASDAQ 100, a lot of the top 100 companies, Apple, Google, etc., they look fantastic, really quite healthy. But if someone's worried about the currency, say running to $1, and then you're buying it at 60 or 72 cents, well, essentially you got to make a lot of money out of Google in order to deal with that currency risk. Does hedging, like, part of the portfolio make sense? And why obviously there's a rhyme and rationale for why I'm asking, but maybe explain it, because if someone, say, to your point, has a super fund and they've opted to go a whole bunch of growth and it is all tech, does hedging a part of the portfolio, make sense in order to cover that risk? Or
it does, I think. We'll get to that next. The other part of it is just thinking out aloud. Technology, if we're thinking about inflation, the start of this year, before the Iranian war, was going to be kind of like broader market participation, right, in equity markets. The supermarkets, the industrial companies, the airlines would all do well because the economy is doing well and interest rates are coming down. Rampant inflation around the world does not impact Apple or Google or Nvidia. Rampant inflation around the world affects everything but tech. So you may, tech is expensive, but in this environment where inflation is, difficult, that's going to be the driver of short-term earnings. In terms of hedging, look, I think, hedging, look, currency's hard to predict, despite having quite a bullish view on the AUD. Currency is inherently difficult because of that overshooting on the upside and downside. I think you want to be in a position for your portfolio where currency is not dictating returns. I don't want to have to call, let's say you're my client. Sorry, Murdoch, we had, it's 2008 and the currency's gone from $1 to 50 cents, but we were 100% hedged. So while your friends, their equity market in the US has done fine because, it's an Aussie. If I'm unhedged and my currency falls from $1 to 50 cents, it's fine, right? I make a crap load of money on my US dollar investments, even if the market's gone down, compared to someone who would have been hedged in that period. So I think you don't want to take a huge bet either way. I've always followed the principle of kind of, upper and lower limits.
I believe the education I had from the high effects when they looked after companies was the maximum they'll allow a company to hedge out was 60%.
Yep.
That was it.
Yeah, and you're never going to get it right. So for a portfolio,
wherever you think it's going to be, and if you think it's the lower, I think it's the higher. Welcome to markets. It's probably going to keep going the direction you don't want to go, or flip on its head really, really quick.
Okay. And look, if the currency was above 80, I'd be saying lots more unhedged. If the currency is at 60, I'd be saying a lot more hedged. And it's simple kind of rules-based systematic portfolio management. I think you want as many drivers
on portfolio management. This is a fun one, right? So the other question I had the other day was, instead of hedging, Murdoch, say hypothetically, I don't know, the US market does 30%, right? Yep. Historically. Say the Australian market does 15% historically, right? Yep. So it's half. If you just own a larger percentage of Australian, equities, and then you own a percentage of US equities, there is an argument, depending on what that percentage is, you may essentially balance out the currency risk. It's not an internal hedge for everyone out there that knows what an internal hedge is, but there is somewhat of a balance on that side. Would you agree with that, or that's pretty much you don't?
I kind of look at, in my head, and it's a bit, investing is science plus art. You can put your total portfolio into an optimizer and it can tell you've got this risk factor, this risk factor, this risk factor. I think a lot of people focus on that too much and call themselves portfolio managers. They rely too much on the quant and the science. To be honest, with AI, everybody can do that. That's not a competitive advantage. Sorry, you give me a spreadsheet on what you think CAPM is and, discount rates and all this, whatever. It's actually the art. What are actual real correlations? What could change that? What's the outlier event? You got to put both side by side. So for me, when I look at my portfolio, I like to see as many idiosyncratic risks that just seem completely, unrelated. And we spoke about it before the call started. Royalties in the resource sector.
Oh my God, I love royalties in the resource sector.
As an income investment, right? So a lot of people buy healthcare royalties, a lot of people buy music royalties. They're fine, but they tend to have a much more finite range of outcomes. Whereas resources, unproven kind of resources become proven resources, and these things just grow over time, right? It can be a small mine that the resource, they prove that there's resources next door, and this thing just becomes 3, 4, 5 times. When I look at something like a royalty strategy in the resource space, to me, that has very little, if any, commonality in risks to, say, Aussie private credit, which, by the way, I really like, and I think is much less riskier than what global private credit is. But let's just say I've got a lot of Aussie private credit, which I do, and I like. And I think the fears last year around it being a systemic risk was completely proven to be factually incorrect, and a lack of understanding. Do I like putting resource royalties next to that? Absolutely. What's driving my private credit, or what's driving my small cap equities, or what's driving my special sits PE, SPV is very different to what the royalties are doing, right? Now, there's going to be broad economic risk. If a nuclear bomb drops on the world and, markets fall 60%, then I don't think I'm going to have much protection. But on a day-to-day basis, and general cycle to cycle, they're different risk factors. So this is the art. This is the art of not looking at what past relationships were or what the textbook says, but having experience in markets and investing alongside clients and being, curious to look for these investments, right? And I don't want the kind of black box, hedge fund, anything can happen. But when I look at, I'm owning an asset like a royalty, which has a claim on revenue of a producing mine, that's an asset that I can put a DCF on. It's worth something. But the actual economic cyclicality or the commonality of other risk factors in my portfolio is minimal. I mean, that's a holy grail. Get me
Yeah,
more of those things.
I can't remember. The funniest thing is when I found it, I called you up. I'm like, by the way, I found this thing. And you're like, mate, I stuck money into it 3 weeks ago.
Yeah.
That was great. It makes sense, right? Look at the Reinhardt family. They sold the mine and kept the royalties.
Yeah, definitely.
And then everyone talks about it now. It's kind of like a no-brainer.
But
If only we find another one.
Yeah, just in another kind of comment, like when you're doing different risk factors, like I think a lot of people get fearful of, taking a different view to the market or career risk. People are also fearful of having something that doesn't work, right? If you're a portfolio manager or you're investing money and you're more fearful on getting something wrong, because investing is not about getting 100% of things right. If you're more fearful of getting things wrong, you're simply going to gravitate towards the mean. And I would say if you're going to gravitate towards the mean, go buy the Vanguard Growth Index Fund and just leave it, ignore it, and hold it, right? But investing is not about getting 100% of things right.
It's about asset allocation and essentially running core and satellites and managing the risk. Since you brought up private credit, wouldn't it be a conversation with you, sir, without getting into that a bit? So what's happening? I think the concern was it Blue Owl, 600 million. And then I think one of the big funds was it BlackRock closed up a fund, didn't allow redemptions, and then that spooked a number of people. Do you just want to explain what happened there? Because they were 3-year business loans, right? And that was essentially, people didn't know essentially the impacts of what was happening with AI and legacy debt and all that type of stuff. But that's not really impacting, private credit in Australia, where you essentially have hard assets backing it, like bridging loans 12 months, 18 months with solid property.
I'll probably get hate mail after saying the differences. So look, I've been very vocal. Last year was all about the media, particularly the AFR, going quite hard on Aussie private credit, which I think kind of missed the point. And then this year, really, through that media obsession, a lot of people piled into global private credit. We'll start with domestic private credit. So Australia is the most lender-friendly market in the world. And what I mean by that is, as a lender, I have complete and utter control, and I do not need to go through the courts to enforce my control. Compare that to the US, is a very borrower-friendly market, right? As a lender, I give up my right to enforce a loan to go through the courts, right? When you've got more lawyers and more courts, recoveries are almost always lower. Recoveries are almost always higher in Australia. That is a structural competitive advantage that is not going to change. Australian corporate lending is fundamentally less risky than the US. Now let's look at the origins of private credit in both markets. In Australia, it's primarily asset-backed. And when we had the Royal Commission into the banks, there was a very blunt policy decision. We want our banks to focus on bread and butter banking products, irrespective of the risk in other parts of the market. So what that meant was the banks focused on mortgages and deposits. There was a massive gap in high quality and low quality lending in the corporate sector, in property. Now let's look at the US market. US private credit, which is predominantly cash flow lending, was created because regulators said we cannot have banks lending this filth with, an implicit government guarantee, right? Banking sector. So they created a shadow banking system. Two fundamental reasons and two very different reasons why they were created. One was created as a blunt policy tool. The other was created as a risk tool, where US regulators have deemed, this kind of lending to be very high risk because it is typically sponsor backed by highly leveraged PE firms, and it shouldn't be within a banking system. Now, if I look at the structural differences between the funds, so you made a very important point. Australian private lending is typically bridge financing. That is inherently lower risk because you don't get caught up as frequently in a cycle. If you're constantly recycling the portfolio, it's constantly changing to the macroeconomic backdrop, to competition and spreads, to all those things, right? And even if, something gets extended, which it always does, and again, this is primarily property, you have security of an asset. You can also get personal guarantees, which can be valuable, might not be valuable. There's also no fund leverage. This is an important one, right? This is an interesting one that people forget. There's no fund leverage or structural leverage in an Australian private credit fund. How business development companies are set up, and that's just a fancy name for how the fund is structured in the US. For every dollar you put in a US private debt fund focusing on cash flow lending, there'll be $1 of leverage. So you've got $1 that you put in, $1 of leverage, and the dollar you're putting in is in highly leveraged companies with terms of anywhere between 3 and 7 years. Now, if you look at the software sector, right, the software index was down 80%. That's the equity, right? What do you think the debt's worth? I mean, they haven't marked to marketed. Now, the issue is not if these companies go to zero, right? It's actually the difference between the bid offer spread. It's a company they think is worth 100 mil. Well, it's not worth 100 mil. And then if it has to be restructured through the courts, what's the value destruction? And this is the final point. Even if you assume US private credit is fine, we are now in an environment where in recovery, in insolvency, what is the recovery rate on an intangible heavy business versus what it used to be like a manufacturing plant where there'd be land, equipment? When a software business goes to zero, or a business service business goes to zero, or a health tech business goes to zero, or a fintech business goes to zero, there's nothing left. The recovery is going to be very minimal. And if anybody is in global private credit, I'd say stress test this with your managers. And if they say technology is only 5, 10, 20, or 30%, go, no, I want actually business services included in that because, the accounting firm and the consultancy firms will be just as impacted. I want the fintechs included. I want the healthcare tech included. And I do think you have some structural problems. And look, I'll go back. Like if you actually look at BDCs, I trade them. I trade the listed versions. By the way, all the listed versions, which are the same as the unlisted or very close, are trading at 20 to 40% discounts to NAV. I actually like trading those. I think they're fun because if the market's putting a discount on something like FSK, which is not a recommendation to buy at all, but if it's putting a discount at 50%, in my head, I go, okay, the market's probably penalizing that a little bit too much. Maybe that's an opportunity to buy. But personally, I think there has to be a pretty high threshold to be buying global private credit at par. One last point, and I'm ranting and raving, but like Aussie private credit, when you've got that security, you've got great creditor rights, you've got high recoveries. In my head, again, the art, not the science, what it tells you, because, it's the art, that becomes less economic sensitive than what a 7-year loan to a corporate that's highly leveraged, right?
Makes sense. But what does that mean? Because there are a number of excellent Australian private funds that do lend to businesses, which you and I both invest in, right? Yep. In case they're listening, we like you guys, do a good job. But I suppose the question in the back of my head is there any impact to those loan books on the Australian business side. But how do the Australian fund managers lending to businesses differ from the exposure in the States where there's a problem?
So I go back to the leverage side, right? The cash flow lending businesses, so direct kind of lending to corporates, almost always there's no other debt on the balance sheet, and debt is being used as a substitute to raising equity. And it's not on a distressed basis. So if I own a business, I need to raise capital because I want to expand. Typically, given the banks don't exist anymore in this space, I'd have to go to a PE firm and sell a large part of my business. And they would get preferred terms, they would get great structuring, they'll take a convertible note. They would get away with anything, right? Which is great if you're on that side. But for a small business operator or a medium business operator, that was really the only alternative. To be able to borrow debt and not dilute yourself is attractive. So I think, by and large, the cash flow lending here is to fund growth. In the US, it's to refinance over-leveraged, sponsor-backed companies that these PE firms have not been able to exit for a good part of a decade.
So with the comments with the AFR and from what you know, private credit, you're still comfortable with, just confirm, you're still comfortable with asset-backed private credit bridging loans, but are you just, for me, you're still comfortable with, business loans from good operators, good lenders in the Australian market?
Correct. Yeah.
Yeah, cool. Thank you, mate. That was for me. That was great. Now, with current markets, right, we have seen a major, this market's been entertaining. I think Trump's taken... Now, with our asset allocation, this market's been very entertaining. I think Trump's taken a leaf out of the Japanese book. I can't remember what year it was, but remember when the Japanese were stress testing markets, the impact of making changes on interest rates and how people behave, and then they ran a study where if we leak that we're gonna say rise the interest rate, then people will try to get their bets ahead of it, and it makes a change anyway. Then they actually don't do it, right, and it has the same impact. I think Trump's people have pretty much nailed this, and they've come out and have said, hey, we're going to blow up everything. And then the market reacts. And then essentially on the day that they're meant to blow something up, they go, actually, hold on a second, we've reached peace talks. We give them another 7 days. And then it just goes back up again. So to your point about how interesting it is that this has been the fastest recovery in so-called a crash history, I'm actually wondering if the crash is being managed by essentially the comments coming out, as in when it's about to dive and crash, a positive one comes out. It's almost just whipsawing. But what I'm wondering is with, because everyone's talking about the Strait, the diesel fuel and all that type of stuff, 2 US ships were allowed to pass, to my understanding. Do you think now that this current rally we're seeing in markets is, and I'm sorry, it's a bit too crystal ball, is it here to stay-ish? Or is it still part of the whipsaw? And I'll back that up with a lot of the macro research that we're engaged with in yourself is discussing that. Interestingly enough, there's been a lot of the futures contracts, large contracts like 10,000 options or whatever. They're still hedging large caps. They're rotating out, and then they're moving into the smaller side tech like the semiconductors and what would you call it, the components. It's more like into the component space, and that's having a massive rip. So I suppose what's currently happening, where are we in the cycle, and where is the money? Where is, if you follow the money, you can kind of see the pattern, and that's where you want to go. So where's the money really going?
Yeah, so I think on kind of it in the short term, it's hard to fight the market. Like, the market's going up, right? Whether or not we like it or not, and whether or not you're invested or not. So I think the next couple of months will be quite supportive of markets. I think the AI infrastructure spend is only partway through. So there's still going to be significant amounts of money spent in the infrastructure and hardware and data centers that will support growth. And, a large chunk of economic growth in the US is still coming from that digital rollout and that AI rollout. And you're starting to see the market reward the second order impacts, right? So the Korean market is, on fire, right? Korea and Taiwan are now individually bigger than the UK market, right? So,
Sorry, what? I didn't know that. You're
yeah,
saying that the
I think that's right. I think that's what I read, but I'm pretty sure.
if this was Joe Rogan, he'll ask old mate James,
Yeah,
Jamie, fact
yeah,
check
like
it.
Samsung is now a trillion-dollar company, right? So these, the demand for chips and the demand for hardware is, extreme, right? And so I think that will support economic growth. But don't forget that markets can do nothing for a long period of time, right? There's been decades where markets have done nothing, particularly inflation adjusted. And I would say the kind of, in 3 years' time, if the market is flat or down a lot, you and I will sit here and go, well, that was obvious because we moved from an easing cycle, the shallowest ever, right? We cut rates for not even a year, and we quickly switched to a global hawkish, tightening cycle. So I'm not saying that's going to happen, but I think hindsight will be, yeah, we should have looked at that. That the regime change of interest rates globally shifted completely upside down. And so so I'm balancing that risk with, and this is the thing, like if you reacted to geopolitics is very hard to trade. And, I don't think anybody's going to be able to do it. Right. I mean, look at, a couple of things there. Like if you sold out in March at the low going, you know what, the market's down 10%, oil could really see the market down 30. If you sold out, well, you crystallize that 10% loss and you miss the 15% gain after it, right? If you look at Israel was like one of the best performing markets last year, despite being, the epicenter of, conflict. It was up like 80%. So I think geopolitics, it's great to talk about, and it should definitely be a factor that you consider, but wholesale changes in portfolios. I'm a big believer that you don't want to respond too much. You want to have a portfolio, right? And this is, you want it to be a collection of ideas over many years, because if you fully invest on day one, then you're really concentrating to everything that's happened in that one period. If you can have a portfolio that's a collection of ideas that's been actively managed over time, has got different ideas in a low interest rate environment, in a high interest rate environment, in a dislocated period, in a normal period, and then you have some cash, you can kind of manage that more effectively than going, let's cut risk by 50%. Because absolutely, you could have sat on this call in mid-March this year and made a very coherent and prudent decision to justify why you're cutting a portfolio's risk by 50%.
And then just like what happened, what was it?
2020.
Well, actually, I won't say the firm, but with a particular decision with the WHO, they decided not to get back into US, equities, and that particular firm pretty much is a ghost of its former self, right? So if that's I don't want to say it because we know a lot of people that work there, but essentially, look, great shop, but one decision was made not to get back in because they believed in the words of a corrupt organization. And it's not the firm that it used to be anymore. So yeah, there is back to the currency. If you're going to hedge, max 60%.
Yeah.
There is risk tools intentionally there for a reason. And look, at the end of the day, the whole reason why financial advisors exist is to help clients not make bad decisions that can have dramatic consequences for decades to come in a state of an emotional panic when they're not really sure about the variables that's happening in the market and what to deal with. That is the nature of, being an asset allocator and running money. That's probably one of the most important things, not making bad decisions at the wrong time out of emotion.
I learned the hard way as a final year student at university in 2008. Sorry, say that back. I graduated in 2004. So that was 4 years into my career. And in 2008, I got scared and sold at the low. And I'll never make that mistake again. Because markets go up over the long term, and markets they can do nothing for a decade or so, but long term, you want to be long the market. You want to be long beta to some degree. But you definitely don't want to be buying high and selling low. I have a simple premise. I've got my favorite, beta funds, and every time they're down a little bit more than 10%, I'll buy more. And over time, they get to be a very large proportion of the portfolio, and I sometimes rebalance between them, but I just kind of let them grow, right?
Great stockbroking mate of mine. I looked at his charts one day on the trading floor. I'm like, mate, your charts are back to front. He goes, what do you mean my charts are back to front? I'm like, well, the green candle's meant to go up and the red candle's meant to go down, but you've actually flipped them. And he goes, yeah. So, but with behavioral psychology, your brain, you've been trained since birth, with essentially stop signs for cars. Green means go, red means, brake. So if you flip the candles on the chart, it's actually better for your brain. So you should get more excited as the price drops. So it should be green going down. And then when you see red, you should actually flip it. I've actually done it a number of times, and it does actually improve how you think and actually see things play out. It's quite interesting.
And don't respond to every headline, right?
The other don't respond. And the other thing is, well, speaking of AI, I have a number of friends that are now using let me say that again. Markets, say stop losses, right, or take profits. How many times has someone seen an order hit a stop loss and then it crashes through and it just goes through like a knife through button and keeps on going? Because everyone's placed the stop losses at that level because essentially a Fibonacci series or something equivalent said that's the level, right? What are your thoughts on people now using Claude, Grok, Accenture to run trading strategies? Like I've got mates that now have an entire Excel spreadsheet, whack it in a Claude, run a project, options, NASDAQ, 200, and essentially say, this is what I'm looking for. Maximum risk I want to take is this, call options only. And they're pumping out 10 to 15% a month, essentially just in scalping, but everything's set up. If you think that and extrapolate it based on all the people that are doing it, practically there could be an argument that a very large part of this entire market is AI driven because they're coming up with the same calls.
Yeah. Again,
how is that impacting, the state of prices and markets?
Yeah, so it's an interesting topic. I'm always very cautious of fads. And I think on those investment committees that I sit in, I'm always the one going, why are we going into this strategy, right? Because everybody else is. So, I think of, and I'm not saying it's right or wrong, but I kind of want the committee to debate it, right? And I'm not sure what the answer is, but we need to debate it, right? And so a big theme at the moment is, right, the death of active equities, right, in large caps, and this massive move into quantitative equities, right? It's like the holy grail. Wow, we can earn 2 to 3% in quantitative equities forever. When I see that, I kind of go, okay, cool. So when does that stop working? So I think I'm not saying maybe it doesn't stop working, but alpha is a zero-sum game outside of leverage. The market produces a set return. You may take more than your fair share, then I get less than my fair share, right? That's how it works. There's no copious amounts and unlimited, infinite amount of alpha. So, the quantitative side, I think, if that's a science, right? Everybody's can do that. That can be automated, like you said, with Claude. There's no competitive advantage around the science. What is important is those inflection points when something that was working is not working, and when regimes change and when factors change, and that's the art.
The art is the rate of change. I love what I named the podcast. It makes so much sense. Coggins, so any final thoughts? I know we've gone through quite a bit. Is there anything that you get asked that we've kind of missed that you always find fascinating?
No, look, it's always an exciting time to invest. There's never a shortage of ideas. I think my comments around politics, right? It's quite passionate about politics. I like politics. But I think there's an extraordinary amount of opportunity to invest in this country selectively. You won't see me personally buying an ASX 20 ETF ever. I think, small companies here, both private and public, super interesting. I think anything linked to AI has got a massive, tailwind, but valuations should be cognizant of. I think the volatility around oil is really opening up some opportunities around divergent paths in emerging markets. You've got countries like the Philippines who, is being really hurt by inflation. You've got Thailand who may not have enough fertilizer for their annual crops. You've got, low rainfall in India, Bangladesh, which is also causing issues. I think emerging markets is going to be interesting. If you can find a good emerging market manager that can kind of take advantage of dislocation, because it's really the only area of global markets where there is dislocation at the moment. And so I think that's going to be quite an interesting pace. I think, if you can generate that, 8-ish% return on resilient, lender-friendly, high recovery private credit, it's a good spot to be. So I'm not finding a shortage of ideas in markets, and you just got to keep talking to people and being open to new ideas.
Pretty much. So if anyone's out there that wants those ideas, give us a call. Happy to have a chat. Anyway, Jason, thank you very much for coming on. It's always fun chatting to you. And, I suppose see you again in another 6 months.
Awesome. Thanks, Murdoch.
Thanks, Jason. Have a good day. Bye.
See ya.